reflect a little bit of margin pressure for many companies. And therefore, we need to be looking at how we are managing the portfolios, which sectors and stocks are we positioned for. That's the only measure that we need to take. It is good for investors to enter the markets through an SIP route or an STP route during such kind of times when there is a little bit of uncertainty in the next 1 or 2 quarters about how margin pressures will play up, or if there is any global uncertainty or inflation risks. Everybody is watching what the Reserve Bank of India will probably do around December 8th when they meet to decide on interest rates. The US markets have already, central banks have already indicated that they will be looking to reduce the amount of support they're giving the market. All of these things mean that the liquidity which was going around all over the world, which was pushing up the prices for everything, might slowly reduce going into the next quarters. That doesn't mean anything dramatically wrong with markets, because there is a lot of good demand. And for Indian companies, with all the measures taken by the government, we feel very confident. What should some of what experts talk about or fund managers talk about, I'm sure, seems like a lot of jargon and technical speak and things like that. So if I were to, that's the reason why at the beginning of the chat, I said that I'm very optimistic, because equity is the only asset class that captures human innovation and progress, and good companies will continue to do well. And we should have good equity portfolios, which are well selected by our advisors and our research teams, as well as by our fund managers. The second thing, very simply, that I'd like to tell you about India in specific is that Indian corporate companies have gone through a lot of stress even before the pandemic. They went through a lot of stress because of demonetization. They also went through a lot of stress because of the GST introduction, both of which were pretty strong influences on corporate India. But what it forced Indian corporates to do is to clean up their balance sheet. And today, more than ever in the past, Indian companies, whether they be large cap or mid cap or small cap, have cleaned up their balance sheets remarkably well compared to 5 years ago or 10 years ago. They were sitting on very strong balance sheets when they went into the pandemic, and therefore many of them who had strong balance sheets were able to weather the storm much, much better. And going forward as well, one needs to look for companies that have cleaner balance sheets, have better operating cash flows. Those are the factors, for instance, that Prudential or PGIM India would focus on in our portfolios and how we sort of allocate our monies for investors. So that's a bit of a nutshell description about the markets. Nothing to be very worried about. In the short term, good to enter the markets through SIP. But if your goals, if your financial goals are medium to long term, by all means, I think equity or hybrid products would be good enough for investors. However, if you have financial goals that might be maturing in the next 1, 2 quarters or 6 months, it is always better to stay in fixed income or much safer mutual fund products that you can be advised for. Now, let me move into the story for today and the theme of today, which is the PGIM Global Select Real Estate Fund of Fund. And why should we be thinking about an idea like this? I'm not going to be using my presentation and graphs and charts and numbers. I'm going to try and very, very simply in layman's language explain why this is such an important or such an interesting theme for all of us to consider. So let me start with a proposition or an example, as you may speak, which is that if I gave all of you an opportunity to go back 10 years and redo all your investments and say that all of your money, put it into 4 stocks, what would be the 4 stocks that any of you would choose by knowing what has happened over these 10 years and how wealth has got created? I'm sure that most of you will think about putting that money into Google and Facebook and Tesla and Amazon and Netflix. And these are the companies that have created massive wealth over the last 10 years. Now, when you think about what is the real reason that these companies created this wealth, you come upon the realization that they made our lives easy across the world. For people like you and me, if we wanted to buy something or sell something or book a holiday or book a movie ticket or make a payment to somebody, everything was made easy using technology. And so investors rewarded these companies for having more and more customers and consumers coming to them. And that is how they became such darlings of the markets, or rather wealth creators over the long term. What had happened is that these technology companies gave us consumers control over one most important aspect of our life, which is time. It gave us the convenience of managing our time much better, more easily, conveniently, and cheaply. Something similar is happening in the second dimension in which we all live, which is space. So if time has been disrupted by these technology companies, what is the change that is happening in the use of space, which is all about real estate, is something that I'd like to be speaking about today. Of course, before I speak about space and real estate, I know that I've spoken about this earlier in terms of why investors should even think about investing some money outside of India and into international funds. And that is because India's stock markets are about $3 trillion in size, and the global stock market is about $106 trillion in size. We are hardly even 3% of the total market capitalization. And there are many, many themes, many sectors, many stocks which have innovation backing them and growth backing them, which are not even available on the Indian stock markets. We all know our Indian markets very well. We know reform measures, we know our political system, we know our consumers. So we will always have 90% in the Indian markets. But it is important to have that 10 or 15 or 20% in international markets for this reason, that there are sectors and companies not available in India. Similarly, when we talk about real estate and real estate space, most Indians just think about residential real estate and commercial real estate or office space. And what I want to tell you is that real estate investing is not just about residential and commercial world over. Most of the profits and the rental incomes and capital appreciations are made not just in residential and commercial, it is made in various other real estate areas like warehouses, data centers, retirement homes, cell phone towers, self-storage, and so many other different kinds of real estate that is constructed by specialized real estate developers who have that specialization and are therefore able to get better rentals on their portfolio or better capital appreciation. So it is not just about residential commercial. Of course, there is residential commercial as well, but globally in real estate investing, that is only about 20 or 25% of investing. 80% or 75% of real estate investing is in all of these other areas of real estate, which I talked about, which is data centers, warehouses, cold storage, retirement homes, cell phone towers, hospitals, hotels, and things like that. Now, what you all must also realize, or may have read about it, but I can keep you informed, that just as I said that the Indian stock market is a $3 trillion market and that the global stock market is a $106 trillion market, the real estate market globally for investment is about $31 trillion. So Indian entire stock market is 3 trillion. The global real estate investable market is 31 trillion. But 95% of real estate investing globally is private real estate investing, ownership of physical real estate investing, and not through securities like REITs, which Ishwaran was talking about, or a fund like this that it is. REITs are a 25-year phenomena, and it is a very popular way catching up and growing world over for investors to invest into real estate. But 95% of real estate investing is physical private real estate investing. And the reason for this is also very clear, that real estate is one of those sectors where information is not very readily available. And many of you will agree with me when I talk about that, about real estate investing in India or many of the emerging markets or Asian markets. Information is not forthcoming. There is black and there is white. And even though there is RERA, which has come about 2, 3, 4 years ago, it still doesn't mean that you have information enough for us to take decisions around what is occupancy, what is tenancy, what is rental yields, what is land cost, and things like that. Information, therefore, is very key in making successful real estate investing. And one very, very differentiating factor about the PGIM Global Real Estate Fund that I want to tell you about is that while most of you may know that PGIM is the world's 10th largest mutual fund, what many of you don't know probably is that PGIM is the world's 4th largest physical real estate owner. We own more than 1,500 properties across 32 cities in 4 continents, with 580 fund managers buying and selling real estate on a daily basis across the world. And therefore, our fund managers who are managing this particular fund has a very, very distinct advantage in managing a product like this, because they have real-time information to know what is happening where around the world when it comes to the various different types of real estate that is going on today. That is the one single most factor why I think people should consider a product like the PGIM Global Select Real Estate Fund, because of PGIM's ownership of real estate around the world and being amongst the top 4 in the world in terms of owners of real estate. This aspect about information being so important and critical to real estate investing, one evidence of that I can give you is that PGIM Global Real Estate, even though it's one of the oldest real estate firms in the world, more than 50 years old, and have created some of the structures we know in terms of real estate investing, they have never invested in China. They never had exposure to things like Evergrande and things that you would have read in the newspaper. They never did that. And that is the differentiating factor of a good real estate fund manager who understands this. And I do want to tell you that there are about more than 445 global rate structures available for investment worldwide. India has 3 of them. You would have heard about Brookfield or Mindspace or Embassy, which are listed rates in India. But globally, there are more than 440 such rate structures. It's a very developed market phenomena. And the reason why it's a developed market phenomena is because of what I said, the availability of information, the availability of good regulation, the availability of maturity of this segment all over the world from an investor's point of view. So the first factor is that PGIM Global is one of the world's largest owners of real estate and therefore has good information about how some of these multiple themes are working around the world and how to profit from it. The second aspect I want to talk to you about is something I mentioned earlier, which is that real estate investing is not about just residential and commercial. It's about various other sub-themes. Let me tell you in layman's language, why should we consider this idea now in all of those different sub-themes? What is changing about consumers like you and me, like we did for technology companies and the wealth creation over there? What do we mean about the real estate space? The first example I'd like to give is that global trade for the last 30, 40, 50 years has believed in just-in-time inventory management. Companies and manufacturers make sure that they have just enough inventory so that they can produce the goods or they can ship the goods to their customers, so that they can be very efficient about their working capital, they can be very efficient about their costs. But this pandemic has changed that, and a lot of companies found that when borders shut down and supply chains broke down and taxes and other things are on the horizon, that you cannot any longer manage your business just by just-in-time inventory management. You need more goods so that you can supply it just in case there are disruptions to your supply chain. And therefore, the global trade and global manufacturers are moving from a just-in-time inventory management to a just-in-case inventory management, keeping more goods with them so that they don't get disrupted. What does this mean? It simply means that companies need more warehouse space. And therefore, warehouses are a very big structural trend in real estate development all over the world and will continue for the foreseeable future because most companies around the world are thinking in the same direction. The second example I can give is of e-commerce companies where you and I are, and consumers around the world are shopping for goods online. Most of these e-com companies are currently saying that, well, we are not going to take 24 hours or 48 hours to deliver to you. If you order something online, we'll deliver to you in 6 hours or 4 hours. And if you're ordering groceries online, we will even deliver it to you in 1 hour or half an hour. What does that mean? It means more space. It means that they are not making warehouses on the edge of the city or on the outskirts of the city. They're looking for smaller warehouses in the middle of the city or cold storage facilities in the middle of the city. And therefore, specialized real estate developers and landlords who have these kind of warehouse space or cold storage space are making much better returns and are able to command much better rents. Let's look at a third consumer behavior that you will agree with me. All of us are going digital. In the pandemic, we went very digital, including old people in the house, our parents. I know my father and mother, of course, they also got very familiar with making payments online and ordering things online as well. People were streaming movies on Netflix and Amazon and so many other channels and things like that. And we are not even talking about 5G. 5G is still coming in the future. Now, when you think about companies doing cloud computing and putting their servers on the cloud from work from home and streaming media, entertainment, gaming, crypto, 5G is yet to come, what does that mean? It means that there has to be a server somewhere in the world. Everything needs more servers, and servers means data centers and data warehouses and server warehouses are a structural growth area in real estate. It's a specialized construction. It is about developers knowing what to do about data centers, the air conditioning, the data security, the links, all of that, how to build it. And that is becoming a structural growth area in real estate as well, and has longer legs to run. I spoke about warehouses. I spoke about data centers. I spoke about cold storage chains as well. Let me also talk about another area that you will be familiar with. Many of us during the pandemic were isolated at home. I'm sure most of you, like me, also did jhadu katka and cleaning of the house, vacuuming the house and doing all of that yourself because none of our help can come home and it was new for us. And we also know of our old uncles and aunties and older parents who were isolated living in their own houses who found it very difficult to manage those houses during that time. This is a trend world over. And in the developed part of the world, what is happening is that people who own these houses, and there they don't own 2-bedroom flats or 1-bedroom flats. They own 2-story houses with half an acre property everywhere in the developed world. They have not been able to manage their homes. And many of the older generation, they are selling their houses and they're moving into retirement homes where the medical facilities are in-house, the laundry facilities are in-house, and everything is in-house for them. So retirement home construction or senior living construction is taking off in the developed world, and that's specialized construction again. World over, we saw that during the pandemic, governments were talking about and media was talking about the lack of medical facilities and hospitals. One of the areas which you will agree with me where governments and countries all over the world are putting in a lot of investments is to create more health infrastructure, hospitals, and healthcare facilities. Specialized construction again. And developers who have the expertise of building hospitals and healthcare facilities are doing extremely well and continue to do extremely well over the next few years because this is a big growing area. So if you can think about what all I said about our own behavior, which is driving the optimism in some of these areas of real estate, whether they be warehouses or data centers or cold storage or retirement homes or hospitals or even hotels. For instance, the PGIM Global Select Real Estate Fund is overweight in hotels and REITs that invest in hotels. Now, if you think about the sector which was probably the most beaten down during the pandemic, it was hotels. Nobody was traveling. Nobody was able to go on holidays. And so hotels were having an extremely bad time. And I'm sure that some of you will agree with me, if not all of you, that today it is difficult to get even a room in a hotel because everybody is revenge holidaying or whatever. Everybody is traveling. Everybody wants to go on a holiday, and hotels are charging what they want. And peak reopening of economies have not yet happened around the world, and therefore business travel has not yet even taken off. So if hotels are having so much demand just by people holidaying, you can imagine how much of that demand will be pent up when the business travel also begins to happen, when more economies keep reopening. And so we are very overweight on the hotel segment already in the fund for the last 6 months and have been benefiting from that. Now, one aspect about real estate, you've heard me enough about talking about the underlying consumer behavior that is driving the profits of some of these real estate areas. One area that you will agree with me is that if there is so much demand, where is the supply, right? Now, in real estate, you will agree with me that supply cannot happen tomorrow. Somebody has to construct an office or a hospital or a data center or a hotel will take 3, 4, 5 years. And already because of inflation having moved up and commodity prices having moved up, steel, cement, aluminium, everything that are inputs into construction have already moved up. So the financial dynamics for real estate owners who want to build new construction has changed. So existing real estate, existing landowners are having the power of charging the rent that they want and also getting the capital appreciation that they want. That is the actual opportunity for getting into real estate investing at this point world over, because consumers like you and me are driving the behavior about the use of space. One darling of real estate investors, which is doing very badly and will continue to do badly, is retail malls. Malls are shutting down all over the world because people are not coming into the malls as much as they used to do earlier because everybody is shopping online. And if you go to the malls, many a time you see that, oh, there was a shop here, now they have shuttered it and they've put something to say that new shop will open. And then again, after 6 months, another shop is shuttered and some new shop brand is coming. And this keeps going on and on. In one of the largest markets for real estate and retail in the world, which is the US, there was at the peak 2,200 malls. Today, there are only 984 malls in the US. Not only that, PGIM Global Real Estate Research says that in the next 5 or 10 years, only 88 malls will survive. And the kind of malls that will survive are the ones which are built in the same commercial building where the office is there and the mall is below and then the metro station is below that. So you finish your office, you shop for your groceries, take a haircut, sit in your train and go home. That is the kind of mall that is surviving. Or you are in a community living where you have the residence, the office and the mall all in the same place. So you can do your shopping, go for your entertainment. You're very close to your office, you're very close to your home. Nobody wants to go travel into one mall somewhere and buy something because that they can order home. So we are very underweight retail malls all across the world, anyway in our portfolio. So I spoke about the first reason why we think it's a great idea, which is that PGIM Real Estate owns physical real estate, is one of the largest owners of real estate in the world. And therefore, we have the expertise and the information with the fund managers to decide what kind of real estate should we invest in. Second, I hope I've given you a flavor about real estate, that it is not just about residential and commercial, and it is about various other areas of real estate that can give people a good rental income and also profit. The third and last reason why people should be thinking about real estate investing is because real estate, which is anything which you can touch and feel, like gold and real estate and commodities, which are called real assets, they react positively if inflation and interest rates go up. So world over, investors are now thinking about the fact that if globally interest rates have come down to almost zero, what are we to expect over the next 3 to 5 to 10 years? It would mean that inflation could go up or interest rates can go up alongside it, which is always good for real estate. You would have noticed that India also, when many of you would have invested in real estate, after 2015, we have not been very keen about real estate in India as much because the central bank, Raghuram Rajan, Urjit Patel, all of them, they brought the CPI in India from almost 10 or 11% down to 4%. Real estate always behaves positively. You get capital appreciation when there is inflation. And inflation has already begun to, if you notice, come out not just in the global markets, but also in the Indian markets. Energy prices, commodity prices, all of them seem to suggest that the higher probability is that from here onwards, rates can only probably harden, or inflation will probably harden. And if that happens, real estate as an asset class tends to not just get rental income benefit, but also capital appreciation benefit. If you look at the data for the last 40 years around the world, rental income has always been higher. In 39 out of 41 years, rental income has been higher than inflation. Rental income globally has been about 7.1%, whereas global inflation in those 40 years on average have been about 3.3%. If you look at long-term data, 20 years about returns from these kind of products, global rates have beaten international equity, gold, bonds, private real estate, everything by 2% annualized over the last 20 years. This particular fund that I'm talking about of PGIM Global Real Estate was launched in 2014. And from 2014 to 2021, this product has, and imagine that this is a real estate product with rental yield at the heart of it, as well as capital appreciation. This product has given a net of expenses return of close to 10% annualized. A fixed income kind of global product, as we look at rental income and capital appreciation, a 10% dollar return in the last 7 years annualized. And we are talking about the last 7 years, which was a bad cycle for real estate, not a good cycle. So if in 20 years, I told you that global rates have outperformed equities, in the last 5 years, they have underperformed equities, and we are thinking about a reversion to mean, or if the inflation and interest rate cycle is starting off, a great opportunity to enter into an asset class which gives you different diversification from equity and fixed income, and take benefit of what is coming into the future in all of these multiple themes of real estate that can give us a decent enough sort of diversification for our own portfolios. So that is the main reason for looking at a product like this at this time. A lot of sophisticated investors internationally, they look at real estate investing a little similar to fixed income investing, where there is a interest rate on a bond, or you get a rate of interest on a bond. In real estate, you get rental yield on a property. One of the most interesting thing about rental yields in a property, which you and I both know, is that rent comes with escalation clause. So rent is one part of income which has an automatic escalation clause every year, and that is adjusted to inflation. That is why most investors are interested into this asset category globally. And we as investors in India, even with this product, we have not caught the bottom. We actually, the movement has already happened in terms of returns. And I think that we still have a long way to go in many of these underlying subsectors of real estate. And I hope that we can all take advantage of a very, very strong theme. When we are talking about this product, we are not talking about another equity fund or bond fund, with so many funds in the market. We are talking of a whole new asset class. The opportunity to invest in an asset class which is otherwise very difficult to invest into, liquidating, buying, stamp duty, registration, so many aspects if you want to do it directly. Here you're investing into a rate fund where it has a daily NAV, and you can get in and get out anytime you want and take advantage of the rental yield and the capital appreciation happening on these beautiful different sectors of real estate all around the world at a very opportune time. So let me stop there. And as I promised, I didn't use the presentation, but I can use it for any questions or things that you may have. So let me hand it over back to Ishwaran for now, in terms of some of his comments or any questions that he may have wanting us to clarify, and then we can take more questions from the audience as well.
Yeah, so thank you, Ajit. We have been receiving, as I had put it in the chat window, that if there are any questions, people can put it in the chat box. We will consolidate so that there's no duplication of the questions, and then we'll keep asking Mr. Ajit. So the first question that has come, Mr. Ajit, is that the funds, do they plan to invest in developing or developed countries? Question number one.
Right.
If both, what is the ratio?
Okay, so let me now then use the presentation to give you a good sense about where we are investing and how. So this is the, uh, you know, allocation for the fund from a geographic standpoint. What you see over here is the dark blue line is the fund allocation to different parts of the world. And the light blue line is the benchmark of the fund, which is the North American rate fund and the European rate fund combined, which represents the entire world. What you see over here is that the fund is 62% invested in North America, which is the US, Canada, Mexico put together. The benchmark is also the same. It's about 61% in North America. Then it has about 12% in Japan. Benchmark is about 10% in Japan. The fund has another 10% in Europe. The benchmark is about 11% in Europe. It has 8% in Pacific, ex-Japan, Asia that is. The benchmark is 12%. And it has another 6% in UK, and the benchmark is roughly about 5%. So I'll answer this question in two ways. One is, rate investing, real estate investing is a developed market phenomena. Any benchmark, as you can see here, this is the North American FTSE, North American rate benchmark. You take the S&P benchmark, MSCI benchmark. Most of them will be developed market focused because it is real estate investing through rates is not very developed in Asia Pac or in the emerging economies. The second aspect is the fund is very, very aligned to the benchmark. That's the exposure it has to different regions. And the fund manager, by way of a risk mitigation measure, has a rule that they will never take more than 2% or less than 2% exposure as per the benchmark weight for a region. It is a risk reducing measure because geopolitical risk and macro risks are certain things that the fund managers want to be very cognizant of. And it is best to therefore be just 2% plus minus of the benchmark and not take any higher weights to geographical regions. As an example, if they wanted to take 20% exposure to UK, because there's a lot of real estate properties which are doing well there. And if Brexit happens, then the fund manager will have a big risk on his portfolio because it will impact the portfolio. So geopolitical risks are something that the fund managers are aware of. They don't want to take geopolitical risks. So they will always be plus minus 2% of the geographical exposure of the benchmark. And that's how benchmarks are. I hope I've answered that question. Ishwaran, back to you.
Yes, there you have. And it's a follow-up to that question. Is there any specific countries that you have shortlisted, or will that always be dynamic?
It will always be dynamic, but the fact is that if we were to talk about the rate investing market, which is one of the largest markets as well, let me give you some numbers around it. Real estate investment trusts, which hold real estate under it and makes it easy for investors to invest, is globally about $2.5 trillion in size. And within that $2.5 trillion, if you look at the maximum number of rates which are traded, they are all in the developed markets, and about 10 to 15 countries put together will make up 90% of all real estate investing. These include the US and Canada and UK and countries in Europe and Netherlands. And if you come to the Asia Pac region, it is usually Japan, Singapore, Australia, and Hong Kong. Those are the developed places where these are. We do have exposure in, as you can see, we have lesser exposure than the benchmark in Asia Pac. We have some exposures in Singapore, Hong Kong, and Australia, a little bit, but much of the exposure you will see will be in the US, in UK, Europe, and Canada, and areas like that.
Okay, the next question is, what measures are taken to ensure transparency?
Mutual funds are itself extremely transparent, where you will be seeing the portfolios almost on a monthly basis. Real estate, as it's a good question, because real estate is an area globally where information is not available as much. But the good part about real estate investing through rates is that rates are listed. And as Ishwaran, you yourself mentioned some time ago, rates are listed and information about rates are available on a daily basis, and underlying portfolio information is available for us on a monthly basis, just like every other mutual fund. And so all of the transparency that's required or updates that is required will always be available on our websites and through advisors Like Purple Pond, we will always be sharing that information of what we are doing, what the portfolios are looking like, what the different weightages are, and so on and so forth.
Okay. The next question is, what is the volatility in this product?
The volatility of this product is as much as equity. So that is at least what you should expect. If you have a product that has over many years, 5, 10, 15, 20 years, if rates have outperformed equities, then it is only something to expect that the volatility also will be like equities. Fortunately, I can tell you that the volatility of the PGIM Global Real Estate Fund is less than the benchmark, and therefore less than the equity markets also, because at least the fund managers, because of their ownership of real estate and understanding of real estate, can choose and pick what sectors and themes of real estate to invest into. When you say volatility, I'm assuming also that some people, people would want to know, what kind of negative returns can possibly happen in the fund. Yes, you must be aware of those kind of questions also. And if I were to look at this fund from the time that it was launched in 2014 to 2021 and go on a calendar year basis, or it maybe in 2018 it gave a negative calendar year, it gave a negative return of about -4% in 1 year. Much lesser than equity markets or much lesser than even the benchmark, but that is possible because it is a listed rate, and rates respond to what is happening in real estate, responds to what's happening in the global economy and incomes as well, just like anything else. And imagine the 2008 crisis. It was a mortgage driven crisis, and so it did have an impact, or a pandemic driven crisis where real estate again did have an impact. So it does have its volatility, but it's a completely different asset class, and it has the potential to give those returns which are different from equity. The other aspect about volatility, which is important to realize as clients, and this might be slightly technical, is the correlation of real estate rates with Indian equity. If the correlation is 1, that means whatever Indian equity does, the real estate, global real estates will also do. And that's not what you want. You want to put your money into different baskets where the correlation of each of these asset classes are a little different. So global rates, the correlation to the Nifty India long term is 0.11 long term. So the correlation is very low. So whenever times are very hard and whenever there is a huge shock to the world, every asset class from gold to equity to real estate to bonds and everything will behave. But what you have to look at it is over a 3-5 year period. And the average sort of a correlation between global rates and Indian equity is 0.11. So it's a very good asset class to add to an Indian equity portfolio because it gives you that extra diversification.
Thank you, Ajit. The next question is, what would be the ideal time frame for investing to consider?
My recommendation would be a minimum of 3 years, for the simple reason that this is a fund of fund, and the fund of fund from SEBI's perspective also has a fixed income kind of taxation, which is 3 years. Taxation is not such a big factor. I mean, after 3 years, fund of funds, you have to pay a 20% tax after indexation. And today, even in equity, you have to pay 10% after 1 year. So if you look at both of those scenarios, there's not too much of a difference. But I would suggest that if you were to redeem out of this fund below 3 years, then any profits you would be paying marginal rate of taxation. I don't think one should do it so quickly. So I would recommend a 3 to 5 year time period. The reason for that, one is, of course, the taxation of fund of funds in India. And the second is that if you're thinking about taking the advantage of capital appreciation in real estate, which is related to inflation, at least even if inflation is temporary, because you and I are not experts to know what will happen. Even if inflation is temporary, inflation will be there for at least those numbers will be there for at least three to 4 years. And therefore, this is a good time frame to look at.
Thank you, Ajit. You have answered the question on the tax implication. Yeah. So as Mr. Ajit told, the debt taxation will apply, which is 20% if it's which is your nominal rate of taxation if it is less than 3 years, and 20% with indexation benefit beyond a period of 3 years. So as Ajit pointed out, it will almost be matching the long-term equity taxation if you take the indexation benefit into account. The next one is, will all the investment be in income earning assets?
I'm sorry, can you please repeat that question? Will all investments be in income?
Will all the investments by these rates will only be in income earning assets?
Yes. Yes, all REITs are globally supposed to invest in underlying properties. About 85% have to be rent-earning assets. These are global rules. Even in India, it is pretty much the same. And therefore, good REITs, who understand the space, they pool their money and invest into, whether it is warehouses or data centers or hotels or hospitals, all of the income that they earn from those leases to those hotels or hospitals or data centers all come back into the rate. So they will all be income earning assets. There is, of course, the possibility, and when I say this, I mean that 85 to 90% of the portfolios are usually that kind of investment. About 5-10%, sometimes the fund managers, if they believe they have to take equity exposure of real estate companies, they can do that as well, which are, of course, very, very large companies internationally. So that once in a while that can happen as well. But it's predominantly, I would say, and as per the fund managers, they intend to keep more than 90% into REITs.
Okay, thank you so much. So the next is the most obvious question a lot of people are asking, and you have also answered it once, but what are the returns in rupee terms?
Well, I think it's very, difficult to actually calculate that rupee return. When you look at, dollar return over a period of time, it's very simple to simply say, add depreciation of 2 and 3% on the rupee, and, you have it. So if you look at the returns of this fund, here is the return on the fund that it has given over from the time of its inception. So if you look at the returns of the fund, it's about, you can see here, it's about 10.5% since 2014, 5 years, 12%, 3 years, 16%, last 1 year has been 26%, YTD about 16%.
We are not able to see it.
Oh, I'm sorry. I thought that this slide, can you see it now?
Not yet.
Okay, so just give me a second. I will just go back to the slide.
It was visible. It was visible.
Yeah, now it's visible.
Okay, fine. Yeah. So as you can see that, these are the dollar returns, and, usually Indian rupee has depreciated about 3%, 3 to 3.4% over the last many, many years. So you can expect that if the rupee depreciates, that's the kind of return that you could get over the medium to long term as well. So this gives you a good idea of what the returns of the product has been. But please remember that these returns have come during a bad phase of the real estate market. The last 5-7 years have not been good to real estate at all, and therefore real estate, if you see even in India or globally, has only now begun to sort of take off as economies are reopening, hotels are reopening, malls and offices and residential rentals are reopening. So it is definitely a great time for real estate for the next many quarters, years, as we can see it. So this return has actually come during a bad time for real estate. So I'm hoping that this could be some benchmark of return, at least as a minimum to think about when we look at the longer term 3, 5, 7 year of investing.
Okay, so the next question once again is related to the fund, which comes about what would be the expense ratio of the fund of funds and the baseline fund?
The total expense ratio that SEBI allows for any such fund is 2.25 in India, which includes the expense of the underlying fund. PGIM India has decided to charge 2% for this product, not the entire 2.25. The reason is because, this is an income earning, this is a rental yield product plus capital appreciation product. So it's like a hybrid product. So we want to keep expenses slightly lower, 2%. That's the total expense that will be paid by the investor in a product like this. The underlying fund has an expense of about 75 basis points. So the underlying fund charges 75. In India, we therefore can charge only the balance 125 as per SEBI, and the total charge paid by the investor is 2% for the regular plan in a product like this.
Thank you. So the other is a slightly more advanced question. The question is that 2 questions on those lines. If allocation to US market is above 60%, won't the huge space available due to closure of so many malls be bought or rented with modification rather than invest for new projects, which will take time and is risky?
I'm assuming that the question is coming from somebody who also understands the US and
Yes,
probably
yes.
things about. So the answer to that question is that retail malls are something that we are absolutely underweight on at this point of time. It is not something that we believe is going to come back in a hurry. You're right in saying that many of these retail malls are thinking about how to survive. Some of them are converting into movie studios. Some of them are converting into warehouses. But the good part about the real estate investing and is what I spoke about earlier, which is that PGIM owns real estate and has an understanding of how these trends are developing. As and when we see that there are good rates which have the right kind of retail mall properties underlying them, then of course we can invest. But please also we have to remember that as far as fund managers are concerned, for them what will matter is there anything else in the real estate space which is given even better value than just malls converting themselves into movie studios or warehouses? If there are other areas of real estate like hospitals and hotels and healthcare facilities which are more interesting, then of course it's a choice that we can make as to how much to give weight to malls versus at this point of time versus what is even more structural growth areas in real estate, like some of the other themes we spoke about. So you're right that retail malls are considering, many of them are considering creative ways of surviving by making themselves into movie studios or warehouses. But some of them are, a long distance away from residential properties and commercial properties, which is why they are failing in the first place or shutting down in the first place. So it is unlikely that those advantages will stay for long. But at the same time, if there are interesting ideas that develop, the fund manager can always buy and sell on a daily basis. So it's up to the fund managers then to decide relative basis what to take now and to take later.
Thank you. So the next question, I think a lot of people's eyes have been attracted to the 60% plus allocation to US real estate. So the next question is US real estate, 62% allocation has been doing quite badly in the recent past. Example, Zillow stopped buying just 2 weeks back. So kindly comment.
I have no idea what Zillow is. And I'm assuming that somebody has a very good idea about what is happening to real estate, in the US. But let me tell you this, that real estate world over is doing extremely well in the kind of properties that one invests into. So if one were to look at the portfolio of the product and look at the various companies that it is invested into, and let me take you through some of those companies. And you can see over here certain names like Prologis or Welltower or Equity Residential or Life Storage. When a fund manager has a very, very deep experience of what's happening in real estate because they own real estate and they are aware of the listed rate space and can decide which kind of real estate rates to go into, it is up to them to get into some of the best of the rates which are doing well currently across the country. So just like you're saying, talking about Zillow, and I don't know that particular company, what I would probably say is that, maybe 6 months ago, 1 year ago, you would have said hotels is a completely, lost area for real estate. And today you can't even get a hotel room in many places and business travel hasn't started off. So it's a very dynamic space. And, one can't really say what is working now or later. I would say that in PGIM India, and personally, I don't have real estate expertise. What I have is my interaction with my global teams to know from them how they see some of these areas developing and the kind of properties that they get into. So if we look at some of the properties that they've invested, and we just spoke about it, whether it is Prologis or Welltower, these are some of the largest rates in the world. We have various other risk measurement tools when they're constructing the portfolio. They do not take anything which is less than $250 million. In terms of size. They don't take any rate more than 5% in a particular portfolio or 20% of daily traded volumes. And those are various other risk mitigation measures that they have in the portfolio itself. And the decision, of course, to decide what kind of different companies should they be holding. I would leave it with the fund managers. I wouldn't have the expertise to say on a specific company or so. Ishwaran, you're on mute, so I'm not able to hear you.
So the next question is another interesting question. It says, does it have alpha, beta, standard deviation like mutual fund to benchmark performance?
It does. It does. So you will get, those informations and, standard deviations for you. It is, of course, something that one will need to compare apples to apples within the particular space of listed rates. and that information also can be made available. Yes.
So the next one is, can we assume that we can use these funds as a hedge against currency, especially if we have goals like children education, because the portfolio seems to be predominantly investing in abroad?
Yes. So the answer to that is predominantly yes. And when I say predominantly yes, the reason is that I'm not a currency expert. None of us are. We don't know if the rupee is going to appreciate or depreciate. The long-term trend of the rupee has been that it has been depreciating against the dollar. A lot of currency people that we speak to from the fund management side believe that the real effective exchange rate for the Indian rupee is actually much higher, to the 74.5 rupees where we are today. It's closer to 90 rupees. And if you look at the Indian government's measures to sort of help India be competitive across the world and make sure that our exports are doing well, they will obviously want to make sure that the rupee is not appreciating. They will want to keep the rupee, softer, so that we are competitive. And therefore, if I were to take a punt or a bet of the probability of rupee depreciation, I do think that it will, it can depreciate further over a period of time, even though it is not, very secular. And when it does that, it answers the question of whether it can be a hedge. Yes, it can be a hedge, because your purchasing power of the rupee against the dollar is therefore being, protected in a manner if you're getting that depreciation benefit by investing into a dollar fund abroad, especially for people who have business abroad or children studying abroad. Some portion of their portfolio exposed to a dollar asset will always have that advantage.
Okay, fine. So the next question is, does investment in cell phone towers also part of REIT investments, or do they come under infrastructure investment?
They come under what's called industrial sector, and therefore you will see some of these sectors in the portfolio over here. You can see on the box on the right side that there is residential, industrial, diversified, retail, hotels, healthcare, storage, specialty, office space, and so on and so forth. We are very underweight office space, as you can see over here, or things like specialty. But if you see healthcare or if you see hotels, we are quite overweight in those sectors. We are underweight retail, for instance. The dark line is the fund, the light line is the benchmark. So it would get categorized under the industrial property.
Okay. So can we largely say this is a product because it provides good liquidity? Number one. Number two, it's been consistently been able to give a hedge against inflation, and also because it has got a dollar exposure. Can these three be the primary defining factors for this product?
Yes, and the fact those all three are the one of the most important factors for considering something like this. At the same time, I think one of the other reasons to consider it also is that it gives you exposure to an asset class that behaves differently from equity and fixed income. So adding a little bit of this in the portfolio allows you to get more diversification than usual. And that is another big reason. And we all know that asset allocation is really at the heart of making sure that we can meet our long-term goals. And here is an opportunity to do it. And for all of the other reasons that were mentioned as well. Yes.
Fantastic. Thank you. So I think all the questions that came in the chat window, we have asked. Now, if someone wants to open up and ask just a few questions, you can open your mic and then maybe raise a hand, then we will allow the mic to be opened and you can ask any question. Anyone has any specific questions that you want to address it, then please raise your hand, or you can open your mic and then ask this question. Okay, just one question has come up in the chat once again, and that's what's the exit load for this fund? And
the exit load for the fund is 50 basis for 3 months.
For 3 months. So any exit beyond 3 months is 0%.
Yes, that's right.
Okay.
All of our equity funds and hybrid funds have the same exit load. We don't have anything different. It's 3 months, 50 basis.
Mr. Ajit, Saravanan. here.
Yes.
Traditionally, we have been advising as 60-40 allocation. So REITs getting included, can we redefine the asset allocation to the investors, including the REITs?
My way of looking at it, Mr. Saravanan, would be that when we look at a traditional 60-40 portfolio, 60 equity and 40 fixed income, I would first look at international equities for about 15% within that 60% allocation. And if I am looking at that 15% within the equity allocation, 5% of that 15 can be a rate allocation because it behaves like equity, has risk characteristics like equity. But from a timing perspective, if you look at what international sort of investors are doing, they're for a brief period of time, maybe they are looking also to reduce the 40% fixed income by another 5 or 10% and add that to rates as a category, which means that the international equity portion for our investors could go in this particular situation to 20 or 25, with about 10% or 5% being in rates, the balance being in the normal international equity. So that's the way probably to deal with it. Look at a 60-40 portfolio. Out of the 60 equity, make international equities roughly 15% as an average asset allocation. And out of that 15%, the 5% can be rates. And for the time being, for the next 3-4 years, I think it could also be recommended that fixed income can be reduced by about 5% and also put into rates, because rates have a sort of rental income kind of property as well. So to take advantage of it in the short to medium term.
Thank you, sir.
Okay, so that's about the questions. I think all the questions in the chat box is up. So would you like to have a closing remark before we can, I think we have taken close to an hour. And you have not had a sip of water, so you can.
I did. I did manage to do that. But just my closing comments would be that for any investment choice that we make, it is important to see not just what the returns have been in the last 6 months or 1 year or 3 years. It is important to see whether there is any underlying structural change in the way demand and supply for that particular category has changed. And in this case, I'm sure that all of us with our experiences during the pandemic and even before can understand logically why consumer behavior is changing within this space. The second is that real estate is not just about residential and office space. There is so many different themes, and specialized constructors and developers do get benefits of rental and capital appreciation all across the world. Third is succeeding in this needs a manager who has deep experience, and PGIM being one of the world's largest private owner of real estate, has that expertise to manage it. And from a timing perspective, inflation and interest rate is at a juncture where an addition like this to the portfolio can give you better diversification and downside protection over the medium to long term. And the final comment I'll make is that while everybody is looking at these investment options, please do take care of your health, because health is true wealth. All of the money that we create is going to be useless if we are going to be laid up on a bed in the future. So please make sure that whatever you can do to make sure that you're fit and healthy, both mentally and physically, and for overall well-being, not just financial well-being. I hope that we do everything that is required. So thank you very much for this opportunity, Ishwar and Saravanan. Thank you so much.
Thank you, Mr. Ajit. Just the closing remark from us. There was a lot of interesting learnings, and the first thing was very interesting for us was this moving away from just in time to just in case. I think that was a very revealing learning for us because almost the whole world was getting paranoid with just in time. And I think the current COVID crisis and the belligerence of China has kind of moved people to looking at just in case. So I think that definitely throws up a lot of opportunity for real estate. and also our perspective of what is a real estate from just being residential investment and commercial investment. Definitely the horizon for us has got widened, because now we know a whole lot of assets can be looked at from a real estate perspective. The third, which has been very interesting for us, is it's been consistently almost 39 out of 41 years, it has bet inflation by a good margin, around 4% margin, 400 basis points. That's a huge one. And then the fact that even in a bad year, this fund has given a 10% CAGR, that can be that's a very interesting input that we have received. And most importantly, now that we are having inflationary pressures across the economies, so both the asset class, all the three asset classes, which is your gold, real estate, and equities, should start faring well. And your last this thing of taking care of the health is very well taken. And more importantly, in case you choose not to take care of health, invest in this PGIM real estate fund, because it also invests in hospitals. So you would at least indirectly gain if you really put your wealth above your health. There is a payback because this also invests in hospitals. Having said that, on a lighter note, thank you, participants, for that great participation. It really makes us feel special. Thank you so much. Thank you, Mr. Ajit, for coming on board and taking our invite and opening our eyes to all new investment opportunities. And we really appreciate your final portfolio allocation that you gave an input. Thank you so much, and good day to you. Have a very happy and a pleasant and healthy weekend. Thank you so much.
Thank you, and wish you all the best to everybody as well.
Thank you.
Thank you.
Thank you.